All right, now we're going to do a practice question. So on June 1st, 2021, One Planet Cosmetics Corp was formed. Its assets, liabilities, share capital, revenue, expenses, and dividends as at June 30th follow. So we have a bunch of different accounts here. So A is prepare a statement of income, statement of change in equity, and statement of financial position for the month. And then B is explain why it's necessary to prepare the financial statements in the order listed in part A. All right, so this question, based off of the prior videos, I want you to attempt this question on your own. So I want you to do the income statement first using the prior videos to kind of formulate it. Then I want you to do the statement of change in equity using the prior videos. Then I want you to do the statement of financial position or the balance sheet using the prior videos. So I want you to pause it right now and I want you to attempt it, then resume this video, and then I'm going to do it for you right now. And I want you to compare your answers to my answers and figure out where you went wrong and kind of correct your mistakes as you go. So please pause right now. So the first step I'm going to do is I'm going to go through each one of these and I'm going to figure out if it's going to be an asset, liability, equity, revenue, or expense. Cash, since it's a future benefit, is going to be an asset, which goes onto the balance sheet. Accounts receivable, which is a future benefit, is also an asset, which goes onto the balance sheet. Accounts payable is a future obligation, which is a liability, which goes onto the balance sheet. Bank loan payable, same thing, it's a future obligation, which is a liability, goes onto the balance sheet. Common shares is a shareholder's equity account, which goes both onto the balance sheet and the statement of changes in equity. Dividends declared is related to common shares, so that means it's a shareholder's equity account. And this goes strictly onto the statement of changes in equity. Service revenue is income generated. This is a revenue which goes onto the income statement. Supplies expense is an expense, it's a cost incurred. And this goes onto the income statement. Supplies and equipment are both future benefits. These are assets that go onto the balance sheet. Now, interest expense, office expense, utilities expense, income tax expense, and salaries expense are all costs incurred, consumed, or used up to help us earn revenues. These are going to be expense accounts that go onto the income statement. So I'm going to prepare the statements here for us in Excel. All right, to start off, we're going to do the income statement first. Remember, three-part title. We have One Planet Cosmetics Corp. So remember, company name, statement name, and the date. So this is going to be the statement of income. If you wrote the income statement, that's fine as well. Don't worry about that. That's technically correct. This is different terms for the same thing. And now we have the actual date. So this is for the month ended June 30th. So this is for the month ended because it says in question 1A to prepare the income statement for the month, not for the year. So we're going to first start off with revenues, correct? And remember, we just listed out all of the different accounts. We only have one revenue account, which is service revenue. So I'm going to indent it and put in service revenue. Since there's only one revenue account, that's going to go directly into the totals column. Remember, subtotal, totals. So this is going to be 24,200, done. So now we're done with our revenues. Now I'm going to go over to expenses. So expenses now. So there's no specific order for expenses, right? You can just put in any order. But remember though, income tax expense comes afterwards though. So going through this list, we're going to first have supplies expense. And since we have multiple expenses, I'm going to put in this column over here. Supplies expense is 2,100. Then I'm going to have interest expense. Interest expense is 800. Then I'm going to have office expense. Office expense is 1,500. Then I'm going to have utilities expense, which is also 1,500. I'm going to ignore income tax expense for now. Then I'm going to have salaries expense, which is going to be 5,700. Now I have all my expenses. So I'm going to put an underline over here because now I'm going to do a calculation. So essentially, I'm going to add up all of the expenses to arrive at 11,600. So what I did to get this number is I did 2,100 plus 800 plus 1,500 plus 1,500 plus 5,700 to arrive at 11,600. Now I have my total expenses. So I'm going to take now my total revenues, which is going to be the 24,200 subtracted by my total expenses, the 11,600 to arrive at 12,600. So this over here is going to be my income before tax. Because remember, income tax expense is calculated based off your income before tax. Then I'm going to do less income tax expense. Since we only have one expense account for this, this is going to go directly into this column over here. This is going to be for 700. And then this 12,600 minus the 700 is going to give me my net income, which is 11,900. So this is a main figure now. So remember, dollar sign over here, because this denotes that all of these are dollars. Dollar sign over here. This established that these are all dollars. Then we're going to have a dollar sign at the final figure with a double underlined. Done. The statement of income is now completed. Now I'm going to go into and complete the statement of changes in equity. So once again, company name, One Planet Cosmetics Corp. And we're going to have now the statement name, the statement of changes in equity. And then I'm going to have for the month ended June 30th. And now we have a bunch of different categories now. So over here, we're going to have the account name. So the actual description. So I'm going to ignore that. Over here, we have the account names. So we're going to have common shares. Then we're going to have retained earnings and then total equity. All right, so we're going to start off with the beginning balances first. So beginning balance, we could say June 1st. Then we're going to have any issuance of common shares. We're going to have any net income. Then we're going to have any dividends declared, which is going to give us an ending balance, which is June 30th. So the beginning balance is June 1st. Perfect. Since this is our first year of operations, our beginning balances are all going to be zero. So now issuance of common shares is only going to impact common shares. And as you can see over here, our common shares were 36,000, which we must have issued throughout the year. So now common shares is essentially done because net income has to do with retained earnings. Dividends declared has to do with retained earnings. So now we can calculate the ending balance in common shares, which is just going to be the 0 plus the 36,000, and then we're done. Now to go over to the total equity, it's just going to be the 36,000 over here. Done. Now the net income impacts retained earnings. Because remember, retained earnings is earnings, or other word, net income or profits that we retain in the business that we do not pay out in dividends. So the net income comes directly from the income statement from above, 11,900. Then in the actual questionnaire, dividends declared is given to us as 1,000. So that's going to be negative 1,000 because we're going to reduce that from our retained earnings. So to calculate the ending retained earnings, we're going to do 0 plus 19,000 plus negative 1,000, which gives us 10,900. To calculate total equity for net income is just going to be 11,900. Because remember, net income doesn't impact common shares, so this is just blank. Same with dividends declared. So 1,000 over here. Then at the end over here, we could do it two ways. Either we could do it by calculating 0 plus 36,000 plus 11,900 plus negative 1,000. Or we can do 36,000 plus 10,900 to arrive at the exact same number. And now for the formatting to finish it off, dollar sign over here, dollar sign over here, and this is going to be double underlined. Done. Now we're going to go over to the balance sheet or the statement of financial position. So once again, the company name, Then we're going to have the statement name. In this case, it's a statement of financial position. And remember, another word for this is the balance sheet, or the classified balance sheet, or the consolidated balance sheet, the consolidated classified balance sheet. It'll varies. And then for the date now, remember, these two, it was for the month ended. For the month ended. For this, it's just going to be at June 30th. That's it. Done. Now we're going to start off with our assets first. So our assets are listed in the order of liquidity. So the order of liquidity is simply what we can convert to cash the fastest. So usually the general formatting of the order of liquidity is going to be cash, accounts receivable, supplies, inventory, prepaid expenses, land, building, and equipment. So we're going to go ahead and do cash first. Cash is going to be 15,000. So that goes in over here. Then we're going to do next accounts receivable. Accounts receivable is going to be 9,000. Remember, we could indent these to keep it easier for the eyes. Then after accounts receivable, we're going to do supplies. Supplies is going to be 1,200. Then in this case, we're going to do equipment. Equipment is going to be 52,000. And then there's no more assets now. So if you look at this, revenues have been taken care of, expenses have been taken care of because of the income statement. The statement of change in equity, common shares, and dividends declared has been taken care of. Now we're focusing on the assets. There's no more assets here. So now we can calculate the total assets. So we're going to sum up all of these guys. We're going to do 15,000 plus 9,000 plus 1,200 plus 5,200 to arrive at 77,200. And this over here is going to give us total assets. So since this is a main figure, I'm going to put a dollar sign here and double underline. Since this is the first number in this column for assets, this is also going to be a dollar sign as well. Now I'm going to shift my attention over to liabilities and shareholders equity. Because remember the accounting equation, assets equals liabilities plus shareholders equity. These two are together. So we're going to have liabilities first. And essentially liabilities, we're going to go into our question. So first we're going to list over accounts payable. So accounts payable balance is 7,300. Then we're going to keep going down. We're going to see which other accounts payables, which other revenues we have. Then we're going to go through the list and see which other liabilities we have. We just have bank loan payable, which is 2,300. Now there's no liabilities that exist. So we're going to add up these two over here to get our total liability. So 7,300 plus 23,000 is 3,300. Since this is the first number under the main heading liabilities and shareholders equity, a dollar sign. Remember, underline over here. Whenever we have an underline, it's because we're doing a calculation. Simple as that. So this over here gives us total liabilities. And now we have shareholders equity. So for this one now, I am literally going to take the account. So we have common shares, then we have retained earnings. So these balances come directly from this over here. We have 36,000 in common shares. Then we have 10,900 in retained earnings. That means now our total shareholders equity is these two added together, 46,900, which matches this number over here. Now we're going to tie it all together to calculate total liabilities and shareholders equity. To calculate this now, I'm going to simply take the 3,300, which is total liabilities, add it in with the 46,900, which is total shareholders equity, to arrive at $77,200. And as you can see, that equals total assets. It balances. We've done it correctly. So double underline, $, that's it. So this is a very good example of how the three financial statements connect. The statement of cash flows is done in a different manner. So that's why we're not focusing in on statement of cash flows in this specific question, but I'll deal with that in later videos. So B, I've already explained it to you. Once again, the net income gets inputted into the statement of changes in equity, the relationship, and then these balances over here go directly into the shareholders' equity section of the balance sheet.